Machine learning is like astrology for people with computer science degrees. Except sometimes it actually works. Today we are talking about regression models. So you have heard about machine learning. Maybe you watched a YouTube video about some 19-year-old who pretends to make millions trading Tesla with this algorithm he coded. Maybe you think linear regression can fix your portfolio after you discover options trading. Either way, you're here because you want to know one thing. Can math actually help me not to be terrible at investing?
Is math related to science?
Math is the language of the universe.
Numbers.
Machine learning in finance requires three things: data, models, and the unshakable belief that this time will be different. Let's start with linear regression models. They're reliable and everyone's first choice. Linear regression tries to find the best line through your data points. The basic idea is simple. You feed the algorithm historical data and it tries to predict future prices. It's the same thing you do when you look at a chart and think, stocks go up. Always have, always will. Except now a computer is making the same mistake, but faster and with more confidence. Here's how you can actually build a regression model for stock prediction. First, you need features. Features are just variables that might predict stock prices. Things like moving averages, volume, RSI, or the number of times Peter Thiel is sweating per day. The key is finding features that actually matter, which is like finding a needle in a haystack. For our example, let's say we are trying to predict Palantir stock. We will use features like the 10-day moving average and trading volume. You split your data into training and testing sets. The training set is what you feed to the algorithm so it can learn patterns. The testing set is what you use to see how well it can predict data that's never seen before. Think of it like this. You study a bunch of past exams questions. That's your training data. Then on the exams day, you face a completely new set of questions. That's your test set. If you truly understood the material, you'll do fine. If you just memorized answers, you just brought shame to your family. Linear regression finds the line of the best fit using something called ordinary least squares. Don't worry about understanding this. Just know that it's trying to minimize prediction errors. The model gives you an equation that looks something like this. Those numbers are called coefficients, and they tell you how much each factor supposedly matters. A coefficient of 0.98 on today's price means tomorrow's price is mostly dependent on today's price with extra steps. Then there's R squared, which measures how well your model fits the data. An R squared of 0.8 means your model explains 80% of the variation in the stock prices, which sounds impressive until you realize that 20% unexplained variation can still bankrupt you. Just a quick reality check. Here's where we talk about why this doesn't actually work when you try to build it yourself. First, markets are not stationary. In other words, the market is changing constantly. Your model might learn that tech stocks always go up during earnings seasons and you start buying. Then suddenly interest rates change and the tech stocks become radioactive and you start panic selling. Yeah, sounds familiar, right? It's like training a dog to sit, then being confused when it doesn't obey commands in French. Second, everyone else is doing this too. Once a pattern becomes predictable enough for your regression model to find, it's probably already been arbitraged away by someone with faster computers and more money. You're competing against the medallion fund, and they have PhD physicists who forgot more about mathematics than you will ever learn. Third, overfitting is real. You crush your backtest with minimal risk, go live, and suddenly your portfolio looks like a charity donation. Most people, even academics, don't actually know how to backtest properly. I won't drag you too deep into this jungle, but here are some of the usual traps. Look ahead bias, survivorship bias, out of the sample testing errors, over-optimizing parameters, ignoring transaction costs and slippage, just to mention a few. For further reading, check out Advances in Financial Machine Learning by Marcus Lopez de Prado. No sponsors, no affiliate links here, just a book that taught me a lot and has become an industry standard. Anyway, here's also a thing nobody wants to hear. If machine learning in finance was easy, everyone would do it successfully. The fact that most retail traders lose money should tell you something. Regression models in finance absolutely work when they're built by the people who know what they're doing. The problem is all the good ones already work for Merrill Lynch or Two Sigma, making more money in a day than you will ever see in a lifetime. You know that PhD guy in quantitative finance from China who could build your model that actually prints money? Yeah, he's already been snatched up by Jim Simons. The quant firms have basically created an academic brain drain, where anyone with a PhD in physics or math that likes money is already dragged in. But here's where it gets interesting. Most retail investors are still using technical analysis from the 80s, while institutional investors have moved on to machine learning models. The gap between institutional and retail tools has never been wider. What if there was someone from our camp, someone with a PhD in theoretical physics who didn't went to the dark side, but stayed on the poor side with the other bag holders? Well, that's me. Which is why I spent the last 2 years building Stocknear, a retail investor platform where you can start analyzing stock like a pro. Let me all do the heavy lifting and math while you get all the data with a beautiful modern UI. You can have regression models, classification models, and an AI agent all in one place, without coding, without Bloomberg terminal bill. It's affordable and it's running on live market data. Check out Stocknear.com if you want to see what happens when you have your own Chinese quant combined with institutional grade data with a modern UI. Because the future of investing is all about having access to the best tools. If you like this video, don't forget to like and subscribe, and I'll see you in the next one.